on the whole, it will be fairly stable. To talk about what 2023 looks like for the IT sector, is this going to be an industry-wide phenomenon? We're now joined by Girish Pai of Nirmal Institutional Equities now. Girish, morning. Rima here. First, your key takeaways from the HCL Tech Investor Day, which took place on Thursday midnight, and what the management had to tell CNBC TV 18 and the implications for the rest of the IT companies.
Yeah, first of all, thanks for having me on. So I think what HCL Tech is indicating that second half is going to be challenging, probably a bit more seasonal than has normally been the case. So last couple of years, if you discuss FY22 or FY21, we've had 3Q and 4Q to be reasonably strong, whereas we're going to go back to the seasonality situation that the industry has generally been facing pre-pandemic, and more so now because we have macro headwinds that the customers are facing, and they are, at least some of them are, instituting larger furloughs as we speak. So 3Q is going to be probably a little bit more weaker than what the street was anticipating. And I think it's going to be an industry-wide situation because some of these customers who are instituting these larger furloughs are probably going to be are working probably with the larger vendors across the industry and not so much HCL Tech specific. So that is something that in the very, very near term, I think from an FY24 or 2023 perspective, we are among the more cautious analysts in the street. We are expecting, low single-digit to mid-single-digit kind of revenue growth in US dollar terms. I think my peers in the industry are working with high single-digit. I'm working with a situation where there's going to be a little bit of margin, a little bit of pricing pressure coming through in FY24. So just as the HCL Tech CEO was kind of mentioning that it's getting more difficult to get price increases, or the price increases are far more selective now than they used to be like 6-9 months back. My take on that is that as we move into 2023, we will probably see customers kind of push back on pricing, and we'll see some pricing cuts come through, or the mix change is going to probably result in some of the price decreases that I'm kind of instituting. So I'm fairly cautious on FY24, and from a structural perspective, my sense is that industry is probably going to grow at maybe 100-200 basis points faster than, say, the 7 to 8% growth we saw pre-pandemic, versus probably my peers working with maybe 400 to 600 basis points faster growth. So probably that's the kind of construct I have. I'm fairly cautious both from a near-term perspective as well as from a structural perspective.
All right. Hi, Girish. Good morning, and thanks for joining us. This is Pavitra. So, you were mentioning that this is not likely to be an HCL Tech specific problem. It could, span the entire industry. What is the kind of growth rate that you could, or decline in growth that you would pencil in for some of the larger players, the likes of Infosys? And also this pain that you're talking about on the furloughs, of course, and also the pricing situation. How long do you think that's likely to last? So, I mean, all of this year and then all of FY24 as well?
So I think industry tier one stocks would probably grow in the mid-teens territory from a US dollar perspective for FY23. I'm expecting, a step down from that kind of rate of growth to like 3-4-5% kind of growth in FY24. So that's the kind of decrease in growth rates that I'm kind of looking at. And as I mentioned, I'm in my models, I'm kind of instituting about a 2% kind of a pricing decline, which is not very, which I think is fairly generous. So my base case is that you're going to see a shallow recession in the US in 2023. That's an explicit call that I'm taking. My peers, my competitors on the sell side are probably implicitly assuming that's going to be a soft landing, so to speak, which will probably not mean a pricing decline. So I'm assuming a pricing decline, and that would mean margins will probably remain flat at best. I don't think they're going to improve. Yes, there are various other levers to improve margins into FY24, especially on the employee cost side, and there could be more offshoring happening. But I think a couple of things that will probably go against any material margin increases next year would be, one, pricing compression. Second is, I think there's a unique situation which we've not faced as an industry in the past, even in past recessions, which is that the on-site costs will probably go up even in FY24 because the situation on on-site supply it seems to be fairly tight at this point in time. So broadly, that's the construct I have.
So you're saying margins could come under pressure because pricing is likely to decline by 2% and on-site costs are going to go up. So is the street overestimating margins, and what could be the downside risk?
See, I'm not really, my sense is that FY24, we're going to see probably flat margins. So obviously there are both puts and takes to the margin situation. So on the positive side, my sense is that you're not going to see the kind of salary increases you've seen in FY22 or FY23. So that is one positive. I think utilization can move up. I think some of the cross-currency headwinds that were there may probably not be there in FY24. But on the other side, on the negative side, my sense is that pricing could be a bit of a challenging situation versus the flattish kind of expectation that my peers have on the street. I think pricing could probably come under pressure. I'm taking just a 2% kind of a decrease. It could be much larger if you go back in the GFC timeframe or in the post.com timeframe. You saw mid-single-digit to high-single-digit kind of price compression happening at that in those situations. So I'm not assuming the worst case here. And the on-site salary increases, I think, could be material. I mean, it could have material impact on margins. So I would say those are some of the things I'm working with on the margins. That's all. I'm not assuming a margin compression vis-a-vis FY23, but I think we're going to see flat margins.
All right, got that. That is on the margin front. Girish, within this space, I know you're underweight IT, but within this space, do you have a preference for either the larger names or the mid-cap IT stocks?
Yes, so tier 1 is what I prefer versus tier 2, because tier 2, I think, will come under greater pressure because of vendor consolidation. And my sense is that as the tide kind of goes away, I think, the tier 2 players are going to feel a lot more pressure because there is a lot more client concentration, vertical concentration, service line concentration that these companies have. And, therefore, their businesses are not as diversified as the tier 1 guys are. So I would think that there's going to be more both P-multiple compression and earnings compression that tier 2 companies are going to face. So my preference is more towards tier 1. And within tier 1, if you were to ask me, I would probably rank TCS, HCL Tech, and Infosys in that particular order as my preferential set of companies to invest in.
Have you heard similar commentary about higher furloughs from the other IT companies in your interaction, Girish?
Not really, Rima, because what typically happens is in between quarters, companies really do not come out and see anything very incremental. They just stick to the commentary that they've given in the results, the previous results season. So I think one of the data points to watch out for would be the Accenture results, which are going to come out, I think, on Friday, the coming Friday. And one of the things I would watch out for is whether they're going to change the guidance. So if I look at the guidance they've given for the current year, that is about a 7% organic YOY growth, which is more front-loaded. And I would kind of watch out for whether that number is going to go up. And whether there's an implication in terms of whether the 2H FY23 kind of number for Accenture is going to move up. And if that is the case, I would probably think that could imply some positive, that may have positive implications for the Indian industry because their 2H is equal to our 1H in one sense. So that is a data point to watch out for. So that's coming up on Friday.
All right, Girish, we will leave it at that. Thank you very much for joining us and taking us through your call on the IT space. That was Girish Pai talking about, this entire furloughs problem that HCL Tech pointed out, saying that it is likely to be an industry-wide problem. We could see a decline in growth of around 2%, and that is what it is looking like for the full industry right now. But with that, we're going to get into a short break. When we come back, we're going to shift focus from the world of equities and talk about commodities. Manisha Gupta will be with us.